The question that changes everything. $500 a month. That's less than most Australians spend on food. Less than a car repayment. Less than half what the average household spends on subscriptions, takeaway, and things they forget they're even paying for. But what happens if instead of spending that $500, you invest it every single month, no matter what? No stock picking, no watching charts, no stressing about the news. Just $500 automatically invested month after month. After 10 years, you'd have put in $60,000 of your own money. That's a real sacrifice. That's real discipline. So the question is, what does the market actually give you back? The answer is going to change how you think about money. Let's get into it. First, what even is an ETF? Before we run the numbers, let's get everyone on the same page. Because if you've never invested before, the word ETF sounds complicated. It's not. An ETF, an exchange-traded fund, is basically a basket of shares that you buy in one single transaction. Instead of picking one company and hoping it goes up, you buy a tiny slice of hundreds or even thousands of companies at once. Instant diversification. One click. The most popular ETF in Australia right now is VAS, the Vanguard Australian Shares ETF. For a management fee of just 0.07% per year, that's literally 7 cents on every $100, you get exposure to the 300 largest companies on the ASX: BHP, Combank, CSL, Wesfarmers. All of them in one trade. Then there's DHHF, the Beta Shares Diversified All Growth ETF. One fund, global exposure across Australian shares, US shares, international developed markets, and emerging markets. Zero bonds, 100% growth, 0.19% per year in fees. It's genuinely the closest thing to a set and forget wealth machine that exists for everyday Australians. And NDQ, the Beta Shares NASDAQ 100 ETF, gives you direct access to the 100 biggest tech companies in the world: Apple, Microsoft, Nvidia, Amazon. Over the last 10 years, the NASDAQ 100 has returned roughly 14% per year, almost double the ASX 200. These are the three ETFs we're going to use in our scenario today, and the results are going to be very different depending on which one you choose. The numbers: $500 a month for 10 years. Alright, let's run it. $500 a month, invested consistently for 10 years. Total money contributed, $60,000. If you'd put that into VAS, the Australian Shares ETF, which has returned roughly 12.86% per year over the last 5 years, your portfolio today would be worth approximately $113,000. You put in $60,000. The market handed you an extra $53,000 on top. That's nearly double your money. If you'd chosen DHHF, the Global Diversified ETF with its stronger 5-year track record, you're looking at somewhere between $115,000 and $120,000. Global diversification, slightly better returns, same disciplined approach. Now, if you'd gone NDQ, the NASDAQ Tech ETF, at 14% per year compounded, your $60,000 becomes approximately $134,000. More than double in 10 years, from $500 a month. And here's the part that breaks people's brains. What if you kept going? 20 years, same $500 a month, total contributed $120,000 at 10% average returns, a conservative blended estimate. Your portfolio is worth over $380,000. At 14%, like NDQ has historically delivered, you're sitting on over $600,000 from $500 a month. Money most people are currently spending on nothing. Why most Australians never start. So, if the maths is this obvious, why aren't more Australians doing it? I think there are three real reasons. The first is complexity paralysis. People think investing is complicated. They picture Bloomberg terminals, stock tickers, earning reports. But buying an ETF is genuinely as simple as opening a Combank account. Platforms like Perler, Sharesies, and ComSec Pocket let you buy VAS or DHHF in under 5 minutes with as little as $50. The barrier to entry has never been lower. The second reason is timing anxiety. People wait for the right moment. They want to buy when the market is low. But here's the truth. Nobody consistently times the market. Not fund managers, not banks, not financial advisors. The research is overwhelming. Time in the market beats timing the market every single time. The best day to start was 10 years ago. The second best day is today. The third reason is the fee trap. Australians are losing billions of dollars every year to high-fee managed funds, financial advisors charging 1 to 2% annually, and products with hidden costs. ETFs have basically eliminated this problem. DHHF costs 0.19%. VAS costs 0.07%. The wealth you keep is the wealth that compounds. The one risk nobody talks about honestly. Now, I'm not going to pretend there's no risk, because there is. And anyone telling you ETF investing is guaranteed is lying to you. Markets crash. They always have and they always will. The GFC in 2008 wiped out nearly 50% of share values. COVID in 2020 dropped markets 30% in a matter of weeks. If you'd been investing for 2 years and then watched your portfolio drop in half, the temptation to sell everything and never come back is real. Here's what the data shows though. Every single one of those crashes, every one, fully recovered. And the people who stayed invested through the pain came out on the other side with more than they started. The people who sold locked in their losses and missed the recovery. The real risk of ETF investing is not the market. It's you. It's the emotional decision to sell when everything feels terrifying. Set up automatic investing. Don't check your portfolio every day and commit to the timeline. That discipline is worth more than picking the right ETF. Start today. Seriously. So there it is. $500 a month, 10 years, $60,000 in, potentially $130,000 or more out. And if you stretch it to 20 years, with discipline and without touching it, you are looking at genuine, life-changing wealth built on a coffee a day level of commitment. You don't need a financial advisor. You don't need to pick stocks. You don't need to understand P/E ratios or read the AFR every morning. You need a brokerage account, an automatic transfer, and the patience to leave it alone. If this video helped you see investing differently, hit the like button. It genuinely helps the channel reach more people who need to hear this. Subscribe for more straight talking Australian finance content, and I'll see you in the next one.